Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Wednesday morning, middle of the week. Markets are sort of coming along quite nicely. There is that US presidential debate which is underway. I think should be in the final laps. It's been on for the last hour and a half or so. Lots to talk about here. We're coming to you live from the CNBC-TV18 Offal studios. I'm Prashant. With me, my colleagues Nigel and Reema is with us today. Guys, hi, good morning.
Hi, good morning. How are you feeling? How's your eye?
Eye is doing better actually, until I got a lot of messages yesterday evening and this morning as well. I was wondering that I was off in the morning, so I'm wondering what were they watching. But yeah, maybe some live feed on Twitter or something like that. So yeah, eye is feeling good. I'm feeling good. And the market's looking pretty okay.
So Prashant, before we get chatting about the markets, right? You're a close watcher of the presidential debate. Your quick word, one line.
I mean, I think it would have to be advantage Kamala Harris. Right?
You think?
I mean, I think I only watched the first like 20-30 minutes. Actually, not even watched. It was running in the background.
Yeah.
But then, I mean, a lot was said after that, right?
Yeah.
It's still going on.
100 minutes, so now we're in the last stretch.
Last stretch. So we'll see. The final sort of take from pundits, and we certainly aren't one. But there is a lot to talk about here about as far as markets are concerned, right? I want to take a quick look at, there are some flashes at the bottom of the screen as well. US futures are lower. Dow futures are down more than 100 points. So futures are reacting to, at the margin, to what's happening to the presidential debate and what markets are really taking away from all of it. But yesterday, the market, the Nifty, closed above an important technical level. There was a bounce, nice bounce. 40-day sort of exponential moving average is what the market managed to take out. It would have been a very good session. It was not a very good session. It was just a good session because from the day's high, the market sold off almost about, 80, 90 points. The high yesterday was about 25,130, and we left off at about 25,040. In the last 60 minutes, that pullback really came through. Now, overnight, equities have ended higher. The S&P is up about 0.5%. The Nasdaq is up about 0.8%. So not bad at all. US banks were the most notable laggards, and the index representing that, the KWB index, is down 1.7%. And that is largely because of, new Basel rules which ask large US banks to have more capital, to keep more capital, and that gave during market hours. It was well advertised. There was a Bloomberg article before. It was what came through was in line with expectations. Big drop in yields. Now, the 10-year dropped, 6 basis points to 3.64. And if you look at the entire curve, the 2, the 5, the 10, they all closed at new lows in the last 12 months, right? Now, this is interesting because, last couple of days, it's been kind of confusing because markets have not got a handle of what the Fed will do on the 18th of September. Will they kick off with a big bang 50 or will they stick with a 25? A 25 is what is in the price. There were a large amount of auctions which happened as well yesterday. But I think, bond market was actually pretty strong. So dollar was flat. The other thing, 101.64, nothing very much by way of change. The JPY, the outperformance continued, and the yen is rallied against the dollar, and that's largely, I think, thanks to yields the US yields falling. We're back at about 142.3. The big, the only thing to watch with this, of course, is whether there will be another round of sort of, funding issues, because the Japanese yen is still, over the last, historically, has been a big funding currency in that sense. Oil prices, that's the other big story, and this, I think, we'll talk more, but 3% lower, and Brent oil prices are down under $70 a barrel. It's the lowest in the last couple of years. And this is despite the fact that, OPEC has actually curtailed some of the supply increases to try and sort of push prices higher or support prices. Oil prices are falling. And it is not just oil. If you look at base metals and what has happened there, if you look at iron ore, all of this, of course, is indicative of a weakening global growth picture. China especially is the main reason what sort of global markets are really watching out for. All right, now here in India, just to circle back the levels, we face resistance, and I put this level yesterday as well. Actually, 25,112 is a 61.8% retracement of the previous decline. That's essentially the decline from 25,333, the all-time high, to the recent low. We crossed this level yesterday, but respected it and then fell back under it. So that's the first level to take out on the upside, 25,100 roughly. And I mean, once you're able to sustain above that, you're looking at the all-time highs, which is 25,333. On the downside, the support comes in at the 20-day moving average, which is 24,885. You have the Bank Nifty, which closed above the 61.8% retracement, not from the all-time high, because the Nifty Bank never got to the all-time high, the most recent decline. And, you're essentially looking at a retest of the potential swing high of 51,750. Supports come in at about 50,945 or so. So that's a 20-day for the Nifty Bank. GIFT Nifty will come up on your screen, giving you a quick indication of the open. It's about 13, 14 points lower. I mean, equity indices overnight were higher. But you look at commodities, you look at oil prices, you look at, some of the comments coming in from large global companies like BMW. It's a bit of a mixed picture that you're waking up to. And of course, then you've got this presidential debate, which markets will weigh in a more decisive way once opinion starts to come through. There'll also be, by the way, a polling which is done immediately after, which tells you who won the debate, right? I mean, there'll be a sample, and out of that sample, that sort of verdict in that sense will emerge, and that will put someone ahead, maybe marginally, but I think that's something else to watch out for. Rima.
Well, I'm watching the crude prices. Crude prices plummeted nearly 4% yesterday. We're now staring at a Brent handle below $70 per barrel, lowest since December of 2021. And this is the second time that OPEC has cut the demand forecast. The reason why crude prices have come down is because OPEC Plus has cut the demand forecast, and the cut has come in for the second time in the last 2 months. And now crude prices are down 10% since the beginning of the year. So let me just put on board the numbers, the demand forecast that OPEC has put. So for this year, 2024, OPEC is projecting an oil demand of 2.03 million barrels per day, a cut of 80,000 barrels per day. So that's the cut that's come through. For 2025, the cut has been about 40,000 barrels per day, so it now stands at 1.74 million. So anyway, 2025 demand forecast was lower than that of 2024 at 1.78, but that has been further slashed down. Now, on the sidelines, you could say that a cut in crude prices is positive for an importer like India. But also bear in mind that the cut is because of slowing global growth, particularly China. China is emerging. We know that China was a problem, but now the demand indicators from China appear to be a little worse than what was previously anticipated. So out of that 80,000 barrel per day cut that we've seen for 2024, 50,000 is on account of China slowing down, demand from China. One, of course, is the problems with residential, etc. It's just not picked up. But secondly, it's also the transition to cleaner fuels like LNG, EV, etc. And that's also fueling the cut that we are seeing in terms of, crude demand. So I think that's the worry, right? That is the decline in crude prices in a way signaling that global growth is slowing down? Are we going to be staring at a mild recession? And if you see the way Asia has panned out, Hang Seng in China today is under pressure. Hang Seng is down more than 1%. China is down close to about 0.8%. But the rest of the Asian markets, like Taiwan, etc., are holding up in the green.
Well, that's right, Rima. I think the way to look at it will be a look at those sectors or companies that have more domestic demand and they have a tailwind of falling crude prices. So we'll try to get to that in just a bit. But the buy on dip strategy, well, that's been working. So I think you stick to that. Asian markets, they are lower today. Maybe in the first hour of trade, you start a little bit lower, but you look to buy the dip. That's been working, and that seems to be the case as well. The Nifty Bank, that plays out the weekly expiry. Yesterday, it was promising in the middle of the session, but it couldn't end at the high point of the day. So that will be the big mover in today's trade as well. And as I said earlier, crude oil prices, well, when they are lower, they'll keep select stocks as well as sectors enthused. So we'll keep an eye out on a few of them. In yesterday's trade, you had a bit of a short covering bounce that played out on the Nifty. The Nifty ended with the open interest down by close to around 3% or thereabouts, and it ended higher. On the Nifty Bank, it was virtually unmoved out there. How are things positioned with regard to the client as well as the FIs? The client, they remain net short, not very aggressively, 40,000 contracts on the short side, while the FIs, they remain net long with close to around 150,000 contracts on the long side. So you need to keep that in mind. The client positioning is at around 1.5 lakh contracts. The Nifty Bank, that's the important one in today's trading session. So let's look at a couple of strikes. 51,300 call, well, that's the important strike out there. You had 10 lakh shares that saw open interest build up and 51,500 call as well. Both of them did see some writing, and the premiums did come down substantially from the highs of the day, telling you that there was writing being seen at those levels. Which brings us to the levels then. Going by the options data, going by the recent high as well, 51,500, 51,550. This becomes the important resistance zone. but you'll have to mark your way on the downside because the 20 DMA was recently, breached, but we did recover from there. So this is the important mark. If you can get past that mark, well, we could see a big short covering bounce that plays out on the Nifty Bank as well. The Nifty levels as well come up for you. You have the 20 DMA. Well, that becomes the important mark on the downside. While resistance, going by the options data for the day, 25,170, the bears are positioned that they can defend these levels. Now, since oil prices are at the lowest we've seen since December 2021, there are a few stocks, few sectors as well that will be in focus. Paint companies, we highlighted this last week as well. They're coming out after quite a big underperformance. So we'll keep an eye out on all these names. Asian Paints, that's been the big winner. So maybe the leader continues. So these are the important stocks because of falling crude prices. Input costs go down, so that's good news for them. It'll go down with the lag though. OMCs as well should do pretty well in today's trading session because lower crude normally means good times for them. And Pidilite, we had Nuvama yesterday who joined us on the show, and they mentioned that that could be another potential beneficiary. So in terms of potential beneficiaries of this drop in crude oil prices, those are the stocks and sectors that I'm looking at.
Thank you. Let's get to the equity calls then for the day. It's Lawrence Belanco of CLSA who says, following signs of slowing upside momentum in the month of July and August, the Nifty's uptrend has stalled, with the price action now threatening the support provided by the 50-day moving average, which currently stands at 24,649. A break below this 50-day moving average would further provide evidence of corrective consolidation phase. Below the 50-day moving average, the next chart support comes in at 23,898 to 23,900. A clear break below these levels would signal a change in the behavior, leaving the Nifty vulnerable to a deeper correction. In relative terms, it's worth noting that the NSE mid-cap sector's outperformance versus the Nifty has been capped over the past 3 months, leaving a well-defined trading range taking shape.
Well, we also have Sanjeev Prasad who weighs in. He's, of course, with Kotak Institutional Equities, who says that the recent correction and some of the quote-unquote narrative investment and PSU stocks may reflect mild global risk-off sentiment, changed preference for defensives versus narratives, and increased focus on the fundamentals of these stocks. However, he says he still sees a large gap between the market caps and fundamental fair value of these narrative stocks. So more to go, according to Sanjeev Prasad. All right, so Jeffrey Dennis is with us, independent emerging markets commentator. Jeffrey, good to have you with us here. Thank you very much for your time. Have you been watching the debate, the presidential debate, Jeffrey?
Yes, indeed, I have. I watched nearly all of it before I came upstairs to prep the call.
So who won?
I think probably Kamala Harris won at the margin. I don't think there was any knockout blows, frankly. There were no big mistakes, no big gaffes, as far as I could see. And I think, to be honest, it was the usual recipe of Donald Trump blustering his way through questions, changing the subject, rambling over all sorts of issues, coming up with facts that are clearly not correct at the time, but being very forceful with his arguments, some of which were false. Whereas Kamala Harris, I think, was calmer, wanted to talk about the future, not the past, and I think generally held up very well against ex-President Trump's, what should I say, heated rhetoric. Yeah, at the margin, I think Kamala Harris probably won it, but no knockout blows.
Jeffrey, got it. So I don't know if there's any market implication. I guess not. Second, I want to just ask you about, where yields across the U.S. yield curve, the 2, 5, 10, everything was at, at lows of the year, lows of the last 1 year. Oil prices are down $10 in the last $15 in the last 10 sessions. You've got, base metal prices which are weakening. What does all of it indicate to you? And we heard that guidance from BMW. They've lowered their guidance out of Europe. Not a very pretty picture, right? Just going by some of these growth indicators.
I think that's right. And we've known for a long time, and you mentioned it a few moments ago in the program, that China is weakening and is going to continue to weaken, I think, for a while yet. I think the new part of the story, I think, is that the US economy is clearly at the margin weakening as well. I don't think it's recessionary remotely, but I think spending softening. And obviously, there's some weakness of the labor market coming in now. At least that's what the recent data would tell you. And I think that's going to translate into worries on behalf of investors. The global economy is slowing more significantly than expected. So all of that would be consistent with this steady move down in yields across the curve. The 2-year yield, of course, the 3-month Treasury yield by Treasury bill yield by definition are going to reflect what the Fed is going to do in a few days' time. But I think the 10-year yield hitting 364 and a new low for the cycle, a new low for several months anyway, is reflecting on the weakness of the US economy and to a certain extent the global economy, but of course also the likelihood that inflation is going to fall sharply tomorrow, the headline number, and also the general move we're getting now towards the 2% Fed target.
So talking about this CPI inflation print that all investors are watching, it's important, no doubt, but is it going to be impactful enough to change the decision from a 25 basis points rate cut to 50 basis points rate cut? What is the market priced in? What can surprise?
I think it's possible it could change the cut from 25 to 50, although I think as most people understand now, the real economy data, especially the labor market data, is more important, I think, given how inflation is almost down to target. But the headline number tomorrow looks like it's going to be something like 2.5 or 2.6%, down from 2.9, because the comps with a year ago in August are fairly favorable. The core is going to remain about 3.2. The PCE price index is at 2.5 anyway for July. So I think if you were to get a real downside surprise here, it would really underpin the likelihood in that event that we would get a 50 basis point cut. But it's going to have to be a major surprise. My view is it's 60-40 in favor of a 25 basis point cut at this point in time. But I think people will take a look at the CPI number before they make their final decision on what the call should be.
All right. Hi, Jeff. Morning, and thanks a lot for joining in. Well, if going to be getting some rate cuts, then the dollar is going to weaken a little bit, which is in turn positive for emerging markets. That's normally how we look at it. But your preference from the emerging markets, you've had a view in the past on Mexico, on Korea, on India as well. So could you tell us, among the emerging market basket, what's your preference, and where does India come in the in the pecking list?
I posted on LinkedIn today arguing that there've been two drags on the emerging market index this year, and they've both been quite strong drags. One has been the terrible performance of China once again after 3 prior years of weakness, and the other issue has been the dollar. The dollar is actually relatively flat, up slightly, I think, on the year now, but it's been all over the place, and there's been no reliable dollar trend, certainly in a downwards direction, which has given EM sustained momentum. And since late August, when you've seen people focusing more on 25 rather than 50 basis points from the Fed, the dollar's actually appreciated a little bit by about 3%, and that's pulled the emerging markets back once again. You're right. If the Fed is going to cut and cut more, of course, over the next several meetings, the dollar logically will fall. I don't think it'll collapse. I've got it posted around 112, 113 against the euro in early 2025. That will, at the margin, help emerging markets. I like here India still over China for sure. I like Taiwan to rebound a little bit after some difficult times recently in August. I do like Korea as a bounce back story. I like Brazil over Mexico and Latin America. I called the ASEAN market upside recently, excuse me, and that's been doing well, the ASEAN region, Southeast Asia. And I also like Central Europe. So there's a few things to go on there. But in terms of big markets, India, Taiwan, and to a certain extent, Korea.
All right. We leave it there, Jeffrey. Good to speak with you, as always, and good to get that view across. Appreciate it. Well, that's the global stuff. We're going to talk about specific stocks next with our research team. We're going to look at Asian Paints, Berger Paints, Kansai Nerolac, Indigo, AkzoNobel, all oil beneficiaries. Vodafone Idea will be in focus. Zydus Life, Jubilant, Farm Nova are some of the others which we are going to look at. There'll also be ONGC and Oil India, upstream companies, producers, oil producers, which are perhaps going to open in the red. That's coming up.
Welcome back. Our research team is now standing by with CNBC TV18's list of top stocks for the day. And the big story is the sharp fall seen in crude prices. So Manisha is joining us on the phone line. Manisha, hi.
Well, thank you for that, Rima. Yes, we've seen 4% of decline come in for the crude oil prices in the overnight market. And with this, we are now trading at near 3-year lows for the crude oil prices. Well, a couple of reasons for this decline. One, that the OPEC has cut demand forecast for a second time in 2 months for this year and the next year as well. And the non-OPEC supplies also seem to be increasing. Apart from that, all the data that we saw come in from China has been on the weaker side. The Chinese imports for crude have declined for a third straight month in the month of August. And the analysts are now predicting a potential oil surplus in 2025. While, of course, there is a tropical storm brewing in Gulf of Mexico, the markets also are looking at higher demand expectation from EIA, and the OPEC also has deferred its production increase by 2 months. Well, all of these factors is something that the street is not looking at. If you look at the CFTC data, that shows you that many of the net longs from the money managers also seem to be winding down. So suddenly, everybody is getting very bearish, and we have Macquarie to Citi to Bank of America talking about $60 a barrel of crude oil prices in 2025 right now.
Okay, $60 per barrel. That's the forecast now coming through on crude. Manisha, thank you very much for that. Vodafone Idea continues to be in the limelight. Now, yesterday, towards the close of trade, we flashed that how Kumar Mangalam Birla, in his personal capacity, has bought 1.86 crore shares of Vodafone Idea, and his investment arm, Pilani Investment, bought about 30 lakh shares. This was done on the 6th of September. The exact price is not known, but at that time, the stock price was hovering, between around close to about 13 rupees. Now, the amount that's been purchased in his personal capacity and the investment arm is about 0.3% of the equity. But separately, there is a news article in Mint where the company's spokesperson has told the paper that Vodafone Idea is in active discussions with banks to secure debt funding, which is more than closer to 35,000 crore rupees. An independent and updated techno-economic evaluation has been completed by the banks, which is a precursor for the banks to do any kind of lending. It was done in the past, it was updated, and now this process has been completed by the banks. It's a standard requirement from the banks, so it's one step closer to securing the much-needed banking funding. Yesterday, the stock closed with a gain of 2.5%, but ever since that Goldman Sachs report came where they pegged the target price at 2.5 rupees, the stock has been under pressure, 13.5% lower in the month of September, and from its recent high, which was above 19 rupees, the stock has slipped close to about 30%. So that's the picture on Vodafone Idea, but it's over now to Vinny for Zydus and Jubilant Pharmova. Vinny.
Good morning. So yes, talking about Zydus Life Science as well as Jubilant Pharmova, both are seeing some bit of a positive news. Let's start with Zydus Life Science. Now, they've announced a successful completion of phase 2 trial of the Asnoflast drug. Now, this drug is mainly being used for the treatment of ALS. ALS is a neurodegenerative disease which leads to loss of motor function after some point of time. So yes, this surely means a positive step towards and a hopeful step towards those patients that are being affected by the ALS disease. Other than that, Zydus Life has also received and been granted the orphan drug designation for this drug for treating patients with CAPS disease as well. So keeping an eye out on that, because this also is a disease which leads to rare auto-inflammatory disease, requires special treatment and a possibility that this drug could be used for that. So they're studying further bit more on that terms, as well as they're going to be studying using this drug for inflammatory bowel disease as well. So yes, expanding the use of this drug, keeping an eye out on Zydus Life, surely expecting a green move over there. Lastly, we are also seeing Jubilant Pharmova that has received a notable update. This is regarding the contract manufacturing facility in Washington, and they've received a voluntary action indicated, so not much of a regulatory concern coming in on this front for this facility, and green again is what we are watching out for there.
Okay, all right, Vinay, thanks a lot for that. Well, let's do a quick recap of all the top stocks we just covered for you. Stocks with positive news flow include Asian Paints, Berger Paints, Kansai Nerulac, Indigo Paints, AkzoNobel, Vodafone Idea, Zydus Life, Jubilant Pharmova. All of them will be reacting to positive news flow, while we have ONGC and Oil India that will be reacting to negative news. I'll tell you what, we'll slip into a short break. You come back. David Choksi is waiting for us on the other side. He'll give us his fundamental analysis on a whole host of stocks. Welcome back. Hope you're having a good morning. Well, as promised, let's get some fundamental analysis going. Devin Choksi, MD at DR Choksi FinServ, joins us on the show. Hi, Devin. Good morning and good to see you. Well, the big news overnight is that crude oil prices have slipped to December 2021 lows. Well, one way of looking at it is that you'll fear that the globe is moving into that recessionary mode and things are looking quite bleak globally. The other way is you look for winners. And there could potentially be some that have some gross margin expansion, namely the paint companies, maybe aviation stocks could do well as well. How do you play this first on the positive side with regard to the falling crude prices? Some of the stocks have already bounced up, but there could be headroom for more.
Yeah, Nigel, good morning. I think on one side there are producers and other side there are consumers. The consuming industries, the companies which are basically using the derivatives of the crude oil, which includes likes of paints or even for that matter specialty chemical companies. For them, the input cost coming down is a very good sign. And currently, the crude oil prices are promising to remain at a lower level in the vicinity of around $65 to $75 to a barrel. Now, if this particular price regime continues, then certainly we are heading for a good time for the usual industry of the commodities. And that's where probably I think one would like to count in the companies like Asian Paint, or for that matter, many of the metal commodity companies eventually, I think because of the energy costs remaining down. So from a perspective of looking at the advantage would go largely to the user industry because on the other side, the consumption demand continues in the country particularly. And that is what is giving confidence to the corporate earnings side outlook. However, having said that, I think in a quarter or so, you might see some kind of a mark-to-market inventory loss booking in some of the companies where the inventory have been bought at a higher price and current level of inventory prices are down. So to that extent, accounting adjustment might take place wherein mark-to-market loss might be get booked, particularly in some of the chemical companies' balance sheet. I think you might see that part of it. So that is 1 or 2 quarters kind of a hiccup. But otherwise, I think the overall cost structure coming down is a really good opportunity for some of the companies to expand on the business model going forward.
Devin, sticking with oil and sticking with the decline in crude prices, where do you stand on ONGC? There is a Nuvama note that came out on ONGC where they're talking about two key things. One, that the market is excited with the company's standalone volume guidance of 20%. But Nuvama argues that the company has missed all its past projections, and therefore achieving this 20% volume growth may look a little unlikely. And secondly, it's going to be negatively impacted by the sharp decline seen in crude prices. Have you done some recent work on ONGC? What would be the fair value now? If someone holds ONGC, what would be the advice?
Yeah, Rima, good morning. Well, on one side, you are absolutely right that I think there is a promise about higher amount of production coming in, particularly from the gas side, and that's going to be reality. So obviously, I think that is how I think the performance would look positive going forward on that front. But at the same time, I think the prices of crude oil as a commodity is hard to predict. I would think that I think $65 to $75 is a range in which I think it should go. Within this particular range, I think what could be the performance coming in or how much I think the profit impact may come in, maybe a little too early to talk it out at this point of time, because I think there are various equations which are working. On one side, you have got the lower prices. On the other side, I think you already put some of the contracts. So both these aspects, I think, definitely works, I think, for each other in a way. In my viewpoint, I think one could possibly come up with a number, I think, little after once one sees the stability in the prices. At this point of time, I think since the prices are moving, difficult to predict, I think, which way the numbers will be. But certainly, I think the numbers on 20% growth side, I think is a little bit more optimistic as I see, because these companies have the limitations in producing the higher number of growth. Even if they end up producing one, I think it can be seen as a sustainable growth. That's the challenge that one is facing. So would refrain from putting any recommendation on this particular company. We continue to remain strong with the company's understanding on the business, which is Reliance. And I think that's where I think we believe that the money is best put because they handle the subject very well, even in the volatile situation.
No, got that. Devin, good morning. Just a quick word on two areas, right? The IT services stocks all rallied. I mean, the index itself was up about 2%. And you also had pharma Actually, IT and pharma were the two big gainers. Pharma, of course, there was that Biosecure Act in the US. Divi's, for example, went up 4%, but not just Divi's, Piramal Pharma was up 10% by close. So many others. Just your thoughts on these two areas and what you like in each of these sectors.
Yeah, Prashant, good morning. For IT services, I think we continue to remain extremely convinced about the prospects in the engineering R&D business and the niche play that some of these companies are offering within that, be it companies like Tata Elxsi or Tata Technology or LTTS, LTIM, or even KPIT. I think the battery of these models, I think the business models, I think which they are basically operating, each of them are giving us the visibility of at least next 2 to 3 years of earning outlook. And that's where we like some of these companies from the investment perspective. We believe that I think their customer base is also offering them reasonably good amount of order book visibility in form of placing the new orders. So to a greater extent, I think this businesses look, I think, relatively solid. One can talk about each and every vertical within these companies, but more importantly, I think these businesses are looking good from the customers, the user industry point of view, which they are catering to. Within the pharma space, certainly I think the companies which are in the API and the CDMO space, I think are relatively looking better because the formulation companies on the other side in the global space have actually been, I think, uplifting the material which I think Divi's and Laurus have been struggling with in last few years. I think that situation is past now, and I think they are finding themselves on a much better wicket at this point of time. Similarly, some of the frontline specialty generics, complex generics products manufacturers like Sun, Cipla, and Dr. Reddy, I think they relatively have a better output to talk about, particularly from the US market side. So I think one will have to be remaining a little bit more selective, of course, and I think the opportunity definitely stays higher with likes of DB and Laurus in the portfolio if one is holding.
All right, Devin, stay with us. We're going to come back to you in just a bit. But Anuj is here in the studios, and we're going to focus back on the broader setup, right? Anuj, what are you making of it?
Morning, Prashant. Of course, the big cue today is crude. The way it's come down. Of course, it's led to global market weakness because it's come due to the demand factor, but it's, of course, positive for us. Crude below $70 is a huge macro and micro positive. So FMCG could be the lead sector today. My sense is stocks like Lever, Asian Paints, Pidilite, etc., even Interglobe could be in focus today. Also, the fall in crude is normally algo positive for the Bank Nifty. And Bank Nifty, it's the expiry today. It's due for a 1,000-point move in either direction, depending on which side of the range it breaks. The Nifty IT has also shown signs of taking a support at the 20-day exponential moving average. The only missing piece in puzzle has been Reliance. Reliance all of a sudden has become an extremely weak stock. It's fallen 9% from its recent highs. So that's one stock to keep an eye on. In terms of levels to watch on the index, first I'll talk about Nifty. The first resistance is 25,130 to 25,154 according to me, yesterday's high and the options data zone. And the bigger resistance, of course, the all-time high zone, 25,250 to 25,350. The support is more important, of course, 24,875 to 25,000. Yesterday's low and based on the options data. And then the bigger support is 24,750 to 24,800, the series loop. In terms of the Bank Nifty, where we have the weekly options expiry today, the first resistance comes in at 51,350 to 51,400. The last 2 days of high is placed here. And then 51,406 to 51,552 based on the options data. Above 51,552, my sense is Bank Nifty can see a sharp move to 52,000. The support comes in at 59,50 to 51,050 and then 50,400 to 50,500. For the quote of the day, today is an important day. It's Digvijay Divas. It's September 11, the day Swami Vivekananda delivered that historic speech in Chicago. So I take it from there. All the past in the universe are already asked. It is we who have put our hands before our eyes and cry that it's dark. I said it's an important day also because today is the day, Prashant, Nigel Zima, I came to Mumbai 20 years ago.
Oh, wow. So 2 decades in the maximum city,
2
right?
decades in the best city in the world, yeah.
Absolutely. I'd agree. I'd concur. I would have said it when I moved here back in 2009, but it quickly changes your mind.
Absolutely.
Thank you very much, Anuj, for that. Well, let's, to turn our attention back to the market. I think Devin is still with us. And by the way, we'll also have interesting management joining us in just a bit from now. There is Office, which is, of course, the stock's done extremely well over the last couple of sessions. Now, another area which actually we did not talk about too much, which was under pressure yesterday, was the insurance pack. So the biggest losers, HDFC Life is down 4%, SBI Life is down about 3.5%. Look at ICICI Lombard, that lost about 3.25%. So we basically got the last number was the August number for both from general insurance and life insurance, shows a bit of a slowdown. And the added sort of disappointment in the margin, of course, was that nothing came on the GST front. And there was some expectation that it's been referred to a group of ministers. Maybe we'll get a decision in the next month, 2 months or so. Devin, I just wanted your thoughts here on insurers, and do you own anything or would you like to buy anything here?
Yeah, Prashant, I think to me the life insurance business is on a fantastic wicket actually. You can't be asking for more. On one side, higher amount of GDP, on the other side, higher amount of allocation towards financial assets as a savings and investment component. And every single individual, I think, is basically contributing to the entire process, be it in the area of mutual fund AMC or be it in the area of life insurance premium or for that matter, pension fund or direct equity. So in my viewpoint, I think the higher amount of contribution towards the new premium, new business premium, is definitely, I think, a good possibility in coming period as well. The opportunity is also largely because of the fact that I think most of these life insurance companies are mature now. Particularly, I'm talking about the private sector companies. They've been in business for the last 20 years now. They've matured themselves even on the format of spending money or expenses. And at the same portfolios, they have actually, I think, started playing out the balance role. The par and the non-par policies within the basket of, I think, the policies that companies like HDFC Life or even SBI Life is having. I guess I think they are offering a good amount of prospects going forward as well. And at the same time, I think the reading says that if you continuously grow the business portfolio between 18 to 20% kind of a growth, it means that I think we are steadier with the growth in the life insurance business. Better would be the management, I think, on the financial side or the profit side. Today, the valuation wise also, I think these companies have moderated because in last few years they have underperformed the market. So to a greater extent, I believe that valuations are not expensive. Maybe this correction in the price would be an opportunity to buy into companies like HDFC Life or for that matter SBI Life in the portfolio, even LIC for that matter in the portfolio.
Devin, do stay on. We need to slip into a very short break on that note. On the other side, we'll get chatting with the management of Office. The stock closed up with a gain of 4.5% yesterday, and it's been a big wealth creator since it got listed. It's at nearly 800 rupees versus its issue price of less than 400 rupees in a span of few months. We'll get chatting with the management on the other side. Stay tuned. Welcome back. Now, flexible workspace provider Office Space Solutions recently entered into a business transfer agreement with SMS Integrated Facility to sell their facility management division. With this, Office will raise close to about 27.5 crore rupees. To talk more about this, we have with us Amit Ramani, the CMD of the company. Thank you very much, Amit, for joining in. So first, if you could tell us, what is the rationale for the divestment? What was the revenue contribution from your facility management business? And will you be looking at any more divestments in any of your assets?
So thank you so much for having me on. Clearly, I think to give you a little bit of background, we started this business about 3 years ago as a result of supporting the blue collar staff who at that point was outsourced to third-party vendors and during COVID were not being supported. So we started this with almost no investment, and I think shows the capability of the management team to scale it up to 3,000 people in about 3 years, and now we are divesting it. Clearly, I think the rationale behind it was this is not part of our core service. Clearly, this allows us to free up liquidity to invest in higher growth areas and focus on making sure that we continue to make our market leadership in our flexible workplace solution area that we focus on. Now, clearly, this is cash flow accretive, and it improves the office working capital cycle. It also provides the liquidity and is obviously helping improve the ROCE as well. And it allows us to invest this in areas which are much more higher growth and giving higher returns to our stakeholders.
Got it. All right. Hi, Amit. Good morning and good to see you in. The other piece of news is that Aavas has partnered with Nifty Group for additional 3 lakh square feet of Grade A workspace. We want to understand a few factors on that front. What is the revenue potential of this office space lease that you're going to do? The time period? And are the rentals higher here versus, say, a comparative number in Q1 that you normally see?
So, Nigel, this is a managed aggregation deal, which we have spoken about, where we partner with the landlord, with the largest one that we have done till date. This translates to close to about roughly 7,500 to 8,000 seats for us in a single asset. So clearly one of the largest ones we have done. Average seat realization is about 8,000 rupees in that micro market. So it gives us a huge revenue potential from that asset. Clearly, as you asked about the rentals, clearly the commercial real estate markets are doing extremely well. So realizations in almost I would say every micro market have gone up. Clearly, as the base rentals in all of the commercial markets have gone up. So we see a very, very positive outlook for FY25 and beyond for flex as well as commercial real estate.
Got that. So, I mean, in terms of specifics, would you be able to put any numbers to it? What is the potential? You said 8,000 seats, right?
Yeah,
approximately.
It's almost about, I would say 7 odd crores monthly, which would translate into almost close to about 90 plus crores on a yearly basis in terms of revenue potential.
Sorry, yearly, what is the potential you said?
90 plus crores, 90 crores.
90?
7 crores monthly, 90. Yeah.
Okay. And in terms of sort of margins on this, you typically, how should we look at it?
So if you look at our overall margin when we do these managed aggregation deals at a blended level, we are translating to about close to about 20 to 24 to 25%. This would be somewhere in that similar range.
And managed aggregate deal means you basically you're renting the space. You're renting the space long term. Sort of you rent from a landlord and then you sort of build it out, fit it out, right?
No. So in this case, Nifty is our partner. This is a profit share deal. And as in our managed aggregation portfolio, essentially Nifty Group will be investing about 75% of the capital for the asset, and we would be investing about 25%. And post covering the operating expense, we would share in a 70-30 split at a profit share level.
Okay, 30 in your favor.
That 30 in our favor.
Okay, all right. We'll leave it there. We have more questions, but lack of time this morning. Amit, good luck and thank you for joining us. Stocks done very, very well, and we'll have Amit Ramani back with us to talk a little bit more in detail about prospects going forward. 790 on the stock at this point in time. We'll take a quick commercial break here. Okay, I think Mitesh and Sudarshan are with us, so why don't we go across to them? Gentlemen, good to have both of you here. Thank you for your time. Mitesh, coming to you, how are things set up this morning?
Good morning, Prashant. So, when this decline started, I was hoping for consolidation, and we kind of went slightly below the level which I was thinking the market will take support at, but it's bounced back and is back into the range. Yesterday, we saw 25,150 being tested and failure to sustain above that, and today the opening is very flat. I still believe that the consolidation process could be on. We are just trying to figure out what will be the contours and boundaries. The initial feeling is that we can possibly look at levels of roughly around 24,950 to begin with on the Nifty, and in the worst case scenario 24,800, and on the upside 25,150. If that is clear, then 25,330. I think these are the important supply and resistance levels. But I think the market will go into some kind of a contraction for the next few days. The Bank Nifty has done well. It's met the first target of 51,400. I think the upsides could be there to about 51,750, 51,800 levels. And I think that's the area where I would suggest taking profits on banking positions or Bank Nifty positions if you have.
Sudarshan, good morning. How would you approach trade this morning? Do you also concur that markets are likely to contract from here?
Good morning. Well, I would say that the markets are likely to consolidate, which is not a very big deal because we've had a big run-up. Now some kind of a minor correction is ongoing. Since it's a strong bull market, the corrections are likely to be sideways rather than down. That's what's happening. So expect some up move, some down move, and which it depicts consolidation in a sideways market. Now, within a consolidation, today's trade, and probably for the next few days also, is still to buy a dip. The only difference is that if the markets gap up, if there's a breakout, avoid it. Don't run after a breakout or a gap up. Wait for an intraday dip and then go long with a stop loss. The advantage of this process is that first, our risk is lower. We are buying on a dip. And secondly, if we run after a gap up and the market decides to turn track on that day, we are on the wrong side then. So trade the Nifty on the long side, only on a dip, but trade it.
Got it. All right, gentlemen, request you to stay with us. We want to know your picks as well for the time being. We'll slip into a short break. On the other side, we'll be joined by Apurva Prasad of HDFC Securities. We'll turn the spotlight on the IT sector. Stay with us.
There's a minute to go for the pre-open rates to start to come up. Mitesh and Sudarshan are with us. Let's get their individual trades now. Mitesh, what do you have?
Yeah. So, Prashant, on the I have a mix of buys and sells, and On the buy side, I have Gujarat Gas with a stop at 640 for targets of 680. And Havels is a conditional buy. Buy about 1940, then keep a stop at 1919, look for targets of 1995. A sell on Canfin Home Finance, if it breaks 845, take a stop at 858, look for targets of 815. And HDFC Life is a sell with a stop at 715 for targets of 675.
Okay, all right. What about Sudarshan? Sudarshan, you had given us your view that on the Nifty, only look to get in if there's a dip. But what about individual stocks?
Well, it's mainly on the long side. That's obvious. This market doesn't reward short sellers. But it's mid caps. So I'll start with my only intraday short. Vedant is an intraday short with a stop above 450. Apollo Tyres is a buy with a stop under 510. Balkrishna Industries is another buying opportunity, same sector and same industry, with a stop under 29.70. And Astral is a buy with a stop under 19.20.
Okay, all right, gentlemen, thank you very much, both of you, for running us through the individual trades. I think the first rates are also starting to come up, and we'll put them up for you. Rajesh Palvia is VP Technical and Derivative Research at Axis Securities. He's with us as well. Rajesh, good morning. How are you looking at things, and how would you trade indices first before we get to trade specific stocks?
Good morning, Prashant. So in previous day, we have seen short covering action for both the indices. And looking at the setup now, Nifty's almost crossed the 25,000 level, and Bank Nifty comfortably holding above 51,000 level. So both indices looks attractive for the near-term trading perspective also. We believe some more pullback we could see in today's session. For Nifty, we are expecting that, Nifty, if it continues to hold about 25,000 level, then possible Nifty spot may attempt to move further higher to 25,150. That's the immediate supply zone placed based on the call concentration area. In the previous day, put writers have attracted more on the writing side towards 25,000. So that may act as a good support area for Nifty in any minor, dip. So to play this up move, we are initiating here to buy Nifty 25,050 strike call option to buy, which was closed at around 73 rupees. Keep your stop loss around 40 rupees. And on the high side, we are projecting target towards 125 to 145 for this call option. For Bank Nifty also, if it holds above 51,200, 51,100 mark, I think there is a possibility that we could see some short covering action in the opening trade itself for Bank Nifty, and possibly Bank Nifty may attempt to move 51,500 to 600 zone as we have a weekly option expiry also. So I think upper band for Bank Nifty is 51,600 for the day. On the stocks front, ICICI Bank is looking promising. Almost now stock is poised for giving breakout of its previous all-time high trajectory also. We are projecting target for ICICI Bank towards 1270 to 1280. Keep your stop loss at around 1210. Another stock that we like is Laurus Lab. Very strong buying action in previous day. Stock managed to give breakout above 500 level. So we expect Laurus Lab may extend its gain towards 525 to 530. Keep your stop loss around 596 to buy Laurus Lab. And the third stock is UPL. Continuity of uptrend. Stock is moving in upsloping channel on weekly as well as on the daily chart. We believe that this stock may exhibit further more upside towards 645 to 650. So UPL is buy with stop loss of 610.
Okay, all right. Thanks a lot, Rajesh, for joining in and giving us your take on the markets as well as individual stocks. Well, let's move to a Momentumizer segment then. Sonal joins us to tell us the stock that's on her radar. Sonal.
Good morning. Well, the stock on my radar on the Momentumizers list is Century Textiles. It was up around 5% yesterday. This year so far, the stock has done very well. It's up 103%. Yesterday's average volumes, they were 3 times the average volumes that the stock trades at. And the trading turnover was very high on the NSE as well. Came in at 366.7 crore rupees. And if we compare it with the average, that has been around 97 crore rupees itself in the last 7 days. So big bump up. So it was trading at huge volumes as well. Now remember, yesterday the company company announced to the exchanges that they've acquired the ownership rights of around 10 acre of leasehold land parcel in Worli, and the project has a revenue potential of nearly 14,000 crore rupees with expected high EBITDA margins of 40%. This comes with cost of acquisition of just 1,100 crore rupees. That means the return here is going to be very high, and Ambit says this can translate into PAT margins of 30%, amounting to 4,200 crore rupees of free cash flows. So that's a win-win deal for this company as well, and that's why this big momentum on the stock.
Okay, thank you very much for that, Sona. Now let's put the spotlight on the IT sector. Now yesterday, the Nifty IT index rallied close to about 1.75%. But this morning, we've woken up to weakness in US banks. And remember, US banks feed into the IT sector. They're the largest contributor to the Indian technology sector. So for instance, yesterday, JP Morgan slipped close to about 5%. They've tempered expectation about income from interest payments. Goldman Sachs fell close to about 4.5%, where the CEO has said the trading volumes or trading revenues could fall by 10% this quarter. So basically, the coming quarter could be weak for the US banks. And plus, remember, US banks have to set aside capital. That's what the Federal Reserve has mandated, close to about 9%. So if the outlook for US banks is a bit tepid, does it signal that maybe there is some fundamental weakness for the Indian tech sector? Apurva Prasad, research analyst at IT sector at HDFC Securities, is now with us on the show. Apurva, what's your take on the demand scenario for the Indian IT companies?
Hey, good morning, Rima. Thanks for having me. So demand scenario is incrementally getting better, like what we've been saying for over a quarter now, that the growth and earnings downgrade cycle is behind. It's probably bottomed out, and the protracted IT upgrade cycle and lower discretionary normalizing to H2 is something that seems to be playing out. So I think the odds of that have gone up. Our recent conference where we had about 15 odd companies and a few experts also suggested that there are green shoots in certain pockets.
Okay, but
pockets. And what that improves the probability. Yeah.
Sorry, Apurva, we missed. You were telling us that you concluded a conference where you spoke with a lot of IT companies and the people from the entire ecosystem. What were the key takeaways?
Yes, so like I was just saying that the deal cycles, the decision making on some parts of the business that has improved. There are pockets of BFSI where projects that were held back have started to get released. These are good initial signs, and I think that's also going to start getting reflected in headcount addition. It's been on a decline for many quarters now. So I think there are some incremental positive signs. What that does is that improves the probability of rate of recovery heading on to the second half.
So what is the growth expectation for the second half of the year for the large cap IT names, for the mid cap IT names, and which companies would have standout growth?
So I think companies which have higher BFS exposure would, because that sector is typically first to react, those could probably outperform. So within the larger ones, there is TCS, Infosys, LTI, Mindtree. LTI, Mindtree, where H2 is seasonally stronger for them. Persistent Systems within the mid-tier IT companies, that's the one which has been consistently doing well. But we're looking at a low single-digit growth trajectory, which is moving towards high single-digit over the next quarter. So I think that's the trajectory.
And how much of this is already priced into the stocks? Because the index and individual stocks have rallied 30-40% in the last 3 months. Where is it? Which one would be a top pick?
Which is all the re-rating. So all the 30-35% has been P re-rating. As we've seen that, whenever growth bottoms out, you see P multiples re-rating ahead of earnings upgrade, which is what seems to be happening. I think the profit growth is also going to go up increment. So incremental contribution of profit from a mid-single digit last 2 years is actually going inching up higher. So I think that plus the relative under ownership that still stays despite this re-rating, I think would still provide some tactical opportunities. So if you see from a time series last 5 year relative to where valuations were, I think TCS, Infosys, LTI, Mindtree within the larger ones, risk reward still seems to be favorable. Persistent Systems has been performing consistently, so I think these would be some of the that will outperform.
All right, Apurva, we'll leave it there. Thank you very much for joining us and running us through those details. Let's get our 9-10 calls out of the way. Sudarshan and Mitesh are with us. Sudarshan, what do you have?
I consider buying Balkrishna Industries with a stop under 29.70.
Okay, Balkrishna Industries. Mitesh, what about you?
I'll go with the buy on Gujarat Gas for targets of around 60.
All right. Well, thank you very much, Mitesh, for that. By the way, Mitesh, just a quick word. If you have on these insurers or you already have a call out, yesterday, most of them cracked. HDFC Life, SBI Life, etc.
I have a sell call on HDFC Life today. In fact, the entire space looks like has had a good run up. One leg of the up move is complete, and we are setting for some pullback or correction. So it's not a positional short, but yeah, for the next couple of days, I think these stocks should see supply pressure at any rallies or bounce backs.
On the other side, two names, Tata Power, which was a big mover, and Paytm was up 8% at one point, left about with a 4% gain.
So, the idea is that Tata Power is something, which has been in a big consolidation. If you look at the weekly charts, Prashant, starting from May of 24 till now, I think it's doing a range of about 400 to roughly about 460. I think this consolidation might be coming to an end. Yeah. Yesterday, we saw some moves start. So the first target should be 460, but once it starts breaking beyond that, I should look at 500 over here. Paytm is something, as I said, I've missed the rally. So, it's too late to get in right now. Maybe on a pullback, we'll want to explore that.
6:30 or so. We've talked about paint companies, FMCG companies, upstream companies. How are IOC, HP, BP looking technically as oil has kept coming off?
The initial sense is that the stocks have been, doing very well. IOC, if you look at the charts, so we've not had a weekly closing above 180, 181 since February 24. So I'm waiting for that. We've been hovering around that level. I think the breakout will happen once we start getting past 181, 182 on a weekly basis. HPCL has had a good run up. It's given a correction in the last few days. I think around 410, 412 would be a good entry point if you can get it down those levels, another 1.5% lower. And then keep a stop below 400 and look for a retest of 440, 450 levels.
All right, Mitesh, thank you very much for that. So quick view on a bunch of names there. Well, what's the standout brokerage report this morning? Nimesh is standing by with that. Nimesh, good morning.
Hi, morning, Prashant. The bull versus bear case for telecom stocks continue. We saw a big downgrade last week from Goldman Sachs on Indus Tower. Now today, JP Morgan has upgraded Indus Tower to overweight from neutral, and they've sharply raised the target price to 500 versus 340 earlier. They've identified three reasons for the upgrade. One, they believe that the better prospects from IDEA in terms of capex and tower and tenancy, rollouts, and that should drive low double-digit growth for Indus Tower over FY25 and FY27. Both in terms of revenue and in terms of EBITDA. Two, IDEA's outstanding has now reduced to 4,600 crores. There is quite confidence that the further dues will be recovered over a period of time from IDEA, and that should drive the dividend payout for Indus Tower. If not in FY27, at least from FY26. That's the JP Morgan view. And third, in terms of valuations, given the growth and the dividend yields from 26 onwards, the Indus is trading at close to 7.5 times EV/EBITDA versus Bharti at 11 times and Bharti Hexacom at 13.5 times. So, given all this, a big upgrade on Indus Tower from JP Morgan to overweight now, and they've raised the target price to 500.
Thank you very much for that. Indus stars corrected from levels of 460 at the beginning of September. 30th August is when it hit a level of 460, and it closed yesterday at 425. But this morning, there could be some upside. There could also be upside in oil marketing companies like HP, BPCL. In fact, in pre-opening, they're already up 1.5%. Sonal joins us for more on the oil and gas space. Sonal.
Well, yes, that's the big news, right? That there's been a 4% fall in crude oil prices overnight. It is at a 3-year low. Let's talk about the impact now. For the oil producers, the likes of ONGC and Oil India, it would be a big impact because remember, they have been trading at realizations of around $75 per barrel. But now there is a possibility there'll be an earnings hit. Nuvama says it could be to the tune of 26% if oil falls below that $75 per barrel mark and falls by $10 per barrel. Additionally, even APM gas prices, they are pegged to crude prices. So if there is a further fall in crude prices, there could be an impact on gas prices as well going forward. That would not bode well for both the oil and gas production segment as well. For oil marketing companies, of course, this is a significant reduction that they see in their raw material costs, and this is something that that will aid their refining segment. There was a UBS note recently which indicated that OMC's integrated, that is refining and marketing segment margins, could see an improvement by 2 rupees per litre quarter on quarter in the September quarter. They are already at elevated levels, currently at around 16.2 to 17 rupees per litre for both petrol and diesel. And this compares with an average of 10.5 to 11.7 rupees per litre that they've seen earlier. So there is definitely a positive trend coming in for OMCs here.
All right, just a couple of seconds to go for market open, so we'll keep an eye out on all those stocks, Sonal. What do we have? The first couple of rates starting to show up, and we'll have them up for you. The indices, and then we'll go to stocks. So it's a flat start. So 25,000 around is where the Nifty is starting, 25.25, and the sensex is starting at about 81,800. So those are the Nifty and sensex rates. Nifty Bank starts a little more pronouncedly lower. That's a 0.25% cut, 51,140, 150. That's what you have. Mid-cap index is up about 0.15, 59,100 is where the mid-cap index is trading at, at least opening at. Market breadth is too early, but 4:1 in favor of advances right out of the gates, so it's looking good. And it's absolutely split down the middle as far as the Nifty heat map is concerned. Same number of gainers, same number of losers, but that'll start to change up as we go along. 30 points lower on the Nifty, so we're around the 25,000 level at this point.
Well, let's get to the winners then. The top gainer is BPCL. It's up nearly 2%. HPCL2 has rallied harder, 3.5%. Given the decline in crude prices, the consumers are waiting when will our pump prices come down. Asian Paints also tops the chart. That's rallying now. It opened up higher and now inching towards a 2% gain, a beneficiary of the decline in crude prices. Power names like Bajaj Auto and Power Grid have a green tick at the beginning. Bajaj Auto has been moving well. It's 62%. It's the top gainer on a year-to-date basis in Bajaj Auto. And this morning too, it's opened up with strength. Couple of IT names, TCS, Tech Mahindra, HCL Tech, have opened up in the green. The gains are not much, but it's a positive start to trade. On the way down, it's Tata Motors. That's straight away fallen close to about 3%. There is a UBS note where they're saying that JLR discount spike and should investors worry. So that's the title of the report, and that's pushed the stock down. 825 is the target price set by UBS on Tata Motors, and Tata Motors is on the verge of breaching 1,000 rupees on the way down. ONGC too takes a big hit. You've got cuts in, State Bank of India, ICICI Banks. Banks are a bit on the back foot. Keep your eye on life insurance companies. Remember HDFC Life, they've been the biggest drags this week. So HDFC Life, again, opens up in the red. It's down about 1/3 of a percentage point. And for this week now, it's down nearly 5%. But the mid-cap index at least has a green color.
Well, that's right, Reba. You have a big pullback actually in Tata Motors. You have the UBS note that came in earlier today. They have a sell rating with target price of 825. So, that stock, in fact, is one of the biggest losers on the Nifty. The crude sensitives, ONGC is lower, Oil India is lower. On the flip side, your BPCL and Asian Paints, both of them are higher in trade. Piramal Pharma, that's one stock from the broader markets. It's moving from strength to strength. It was an underperformer post-listing. I think it listed at around 170, 180 rupees. Then it corrected to around 80 rupees. And currently, it's pulled back all of those losses. It's at around 240 rupees. So Piramal Pharma is the stock that we're talking about. Good move is what we're seeing on that front. Other stocks that are losing out today, you have Olympic Pharma that's down close to around 2.5%. While on the flip side, the Vodafone Idea is going to survive. They're going to get the required money. Then Industars could do well. And Industars, after correcting a fair bit, it's pulled back close to around 2% in today's trading session. Zomato continues to run along. We had pointed this out a couple of sessions ago that if it's going to come to the F&O, it could possibly make it to the Nifty in the next review. That will be in early 2025. For the time being, big volumes out there, up 1.5%.
Okay, well, so a fair bit opening up and, starting to come through. But at least at a headline level, at an index level, there isn't very much at all which we can see. Maybe just look at, the other sort of pharma names from yesterday as well, right? Piramal we were discussing in the morning. Divi's, for example, was the big Nifty gainer, was up about 4%. There was Jubilant, which was another sort of big mover, and so on and so forth. So Divi's is flat, Piramal is higher, Jubilant Pharmanova is up about 1.6% at this stage. Look at Paytm. That was, of course, that's been the other mover. It came off the day's highest level, but I think, worth looking at where that is. 653 is turning green as we speak. So that is another one. maybe also quickly look at the life insurance companies, right? I mean, HDFC Life and SBI Life, if there's any momentum or follow through after what we saw yesterday, and we'll take a look at that one as well. So HDFC Life is down another 0.65%, and I think SBI Life is ticking slightly lower, but these are small changes, nothing of consequence, at least at this point in time. All right, Gautam Shah is a market master of the day, founder and chief strategist at Goldilocks Premium Research. Gautam, good to have you with us here. Thank you for your time. I mean, I think the story is the same, right? Buying the dips has worked and it continues to work. But just a quick snapshot view. Where are we at? We had a view earlier from Lawrence Belanco, who was kind of saying that maybe it's getting a little more murkier now. We are kind of flagging momentum. But I don't know if you agree with that, or do you think this is a go-go market still? Go on.
Good morning, Prashant. Well, I think it's dangerous to believe that every single dip in a bull market will get bought into, because at some point of time it will reverse, and when it reverses, it doesn't announce and come. Having said that, if you really look at the setup over the last few weeks, what you'll realize is that the market is looking a little exhausted. I think the up days are not as strong in terms of momentum and participation. In fact, the down days last week has been a lot more stronger. And that makes me believe that there is a battle between domestic liquidity and valuations and global headwinds. Until this battle continues, I don't think the market is going up significantly or going down significantly. So I think the numbers are very clear from a short-term perspective. 25,150, I think, is an important barrier, which we hit yesterday at the highs. And 25,500, 600, according to me, is a sort of a ceiling for now. And I'm not looking at any number beyond the same for the time being. On the downside, I think the 24,800 area is an important support. If that were to break at any point of time, you could possibly see a 5% dip on the Nifty. And as I've said multiple times in the past, 5% is the new 10%. So given that, it looks like as if the indices are just going to broadly stay in a range, oscillate between greed and fear, not go up much, not go down much. And this is still a very sector-specific and stock-specific market, because money has to flow into some pockets. And I think we are seeing IT, pharma, FMCG, chemicals doing extremely well. So those are the pockets to focus on. And basically, the idea is to stay away from the recent outperformers.
Gautam, morning. Rima here. So in IT, pharma, FMCG, which are likely to, see money flow in and stocks do well, which stocks do you like?
Well, I think the entire basket has done very well. I mean, look at the move in Infosys, TCS, HCL Tech, Tech Mahindra. And mind you, IT has come out of a range after almost 2 years. I think the high was tested in 2021, and that number was removed a month back. So I do see a lot more strength, possibly 12 to 15% upside on the IT index. And I think that's the issue, because for the Nifty itself, the leadership is somehow gone, because apart from IT, banks are not doing too well. Reliance has lost its way quite a bit. So just IT index cannot keep propelling the Nifty higher. But as an opportunity, I do see many of these top line stocks do exceedingly well even from here. Add to it pharma. I think what a beautiful structural trend that sector has seen, and I don't see any signs of topping out there as well. So I think both these sectors, which are historically known to be defensives, will continue to do well. And the good thing is they can do well in the good times for the index and the bad times for the index.
Hi, Gautam. Good morning and good to see you. In fact, pharma has been the big outperformer of this year. The index is up, I think, more than 35%. So big move is what we're seeing. Under-owned, batted out, and some of the stocks have come back. But Gautam, before we get back to equities, I wanted your view on a couple of commodities. On crude, that's Brent crude is below $70 per barrel this morning. Where do you see that number headed? And also gold, which has been twinkling of late, holding at around $25 an ounce, $2,500 an ounce. View on both these two?
Yeah, I think it's a good point. I think that's the problem really, because there are some global headwinds, and that's been validated by what has happened on NYMEX crude in the last few weeks. Mind you, for almost 12 months, NYMEX crude was in this band of about 70 on the downside and 95 on the upside. Breaking 70 only means that there is a problem. There could be a problem economic-wise. And I think with the follow-up that you've seen in the last 5 days, it does look as if NYMEX crude is going significantly lower from here, maybe another 10, 12, 15% downside, which I think will be a little problematic. On the other hand, if you look at gold and silver, they remain absolutely steady on the charts. In fact, I do believe that gold will go on to do very, very big things over the next 6 to 12 months. And that's been our stand for the last 18 months. So I think that's clearly an opportunity. But to add to that, I think the US markets for the first time in a year are looking a little wobbly on the charts. I mean, the NASDAQ is losing its leadership with what's happened with NVIDIA, with all talks around what Warren Buffett has done to Apple and his cash positions. And the price action itself has not been all that encouraging. So when you have a slightly negative US market action, it puts pressure on Indian markets, which are anyway trading on very high valuations. And because of the domestic liquidity and these global factors that I just highlighted, I think the market will broadly be in the range, and that's the best thing for us to happen right now.
On gold, you said it's poised to do big things. You want to put some levels to it, Gautam?
Yeah, sure. I think our short-term working number on gold has been about 2650. Now, that's not far away, but we've been riding it right from 1900 levels. But if you have to talk medium-term, long-term, I think over the next 12 to 18 months, you will see a $33.50 on gold, which is a nice 25% rally from where we are. And I do see a similar 25 to 30% upside on silver coming in. So at levels of 28, 28.5, I think the downside is very limited and the upside is large. So it's these are structural charts and they have followed up beautifully. They've handled the bad times beautifully. So I think that's where capital should be committed to a larger extent.
Sorry.
And you said crude prices can fall 10 to 15%. So on Brent, we're looking at $60 per barrel?
Yes, and lower, and lower.
And lower. Yeah. And what does that mean then for, say, paint companies or any of these oil marketing companies or ONGC Oil India, conversely, on the way down?
Well, I think you have to take a stock-specific call there. But I think the two key points, one is crude going and sustaining below 70 on NYMEX means that there is a problem globally, because otherwise you would not have seen this mega breakdown that has happened in the last 10 days. So that's point number one. Point number two, many of the outperformers of the past, the auto sector, the capital goods, PSU, real estate, they've all lost their leadership. If you look at the last 2.5 months, they've all been sideways. And as the Nifty hit levels of 25,000 and beyond, these sectors haven't participated. So clearly smart money has gradually moved out of these spaces and moved into other spaces.
Just to I want to go back to what you began by saying. So I'm paraphrasing here, and correct me if I'm wrong. What you're saying is this is still a bull market, but near term risk reward is a bit uncertain. So be a little careful. Am I paraphrasing you correctly?
Yeah, absolutely. I think medium term, long term, we remain absolutely bullish. I think there are no signs of topping out on the charts. It's just that we've come to a point where the short-term studies are not in sync with the price action anymore. I think the market needs a 5 to 7% kind of a cool off. Whenever it happens, it might not happen maybe in the next 2 weeks. But I think the last quarter of the calendar year, October to December, is when one will have to be a little conservative. Mind you, in 2021 and 22, we had a similar scenario where for about 6 to 8 months, small caps went into a 12-13% correction, and then they came back strongly. So it's just that be careful what you're buying at these prices. I mean, stay away from anything that is narrative based, that is story based, and that is richly valued. Those are the pockets you want to stay away from. There is still a lot of pockets which offer value, and I think one could commit into that. I think NBFCs is one space that we've been liking. Chemicals is one space that we've been liking. Metals also to a certain extent. I think one can commit capital into them.
Right. No, I get that. So just a quick word, in PSUs, right? Are we starting to see momentum there flagging, taking a decisive backseat, Gautam?
Momentum has been taking a backseat for a couple of months now. I mean, you don't see PSU stocks move with the Nifty, and that's very clear when we see the ratio charts that the outperformance is absolutely gone. It's just that the indices are steady and therefore PSU stocks are not correcting much. But if the indices were to get into a bit of a correction, then I think PSU stocks will come under pressure. Again, long term, all is well because they are still not in fraud territory, or exuberance territory in some sense. But near term, I think they require another 5-7%, maybe even a 10% dip before things get back on track.
Gautam, you said you like select metal stocks or metal names. What do you like out there? Because this Chinese data is worrying me a lot, particularly the export data. Yesterday, there was this headline that Chinese exports beat estimates. Most worrying aspect for me. That means they're not consuming enough. But, normally when things go so bad, it normally hits a trough. So what do you like from there?
Yeah, that's true. I think even when I speak to a lot of top managements in the metal space, the message is that on the ground, things are not all that good. But the stock markets are a discounting mechanism, and I think they have discounted a lot into the future. So I think a lot of the current negatives are already in the price. And if you look at the metals index itself, I think 8,500 on the downside and 9,700 on the upside is clearly the band. Whenever that breakout past 96, 9,700 comes, I think it'll be an opportunity. And mind you, metals as an index has doubled over the last 12 months. So it needed that consolidation. It's happened in the last 3 months. And I think many of these top stocks, JSW Steel, JSPL, Nalco, SAIL, Vedanta, Hindalco, I think they all look very good opportunities from a 6 to 12 month perspective.
No, I get that. So, Gautam, would you want to name 3-4 sort of ideas you can leave with the viewers on a positional basis?
Well, I think, as I said, among the top sectors, if you look at IT, I think TCS, HCL Tech, Tech Mahindra have been right on top of our list. In the FMCG space, I think ITC and HUL have been on top of our list for a while now. In the NBFC space, I think Bajaj Finserv and Bajaj Finance, I think, offer great value from a charts perspective and from a valuation perspective. And I see a lot of comfort in terms of margin of safety. And in the pharma space, I think stocks like Dr. Reddy's, Cipla, Sun Pharma still offer great value. So honestly, I'm just sticking to top quality right now. I think I don't want to go even into grade B and grade C, given the fact that we seem to be at very elevated levels.
Okay, well, it's a large cap list, right? Thank you very much, Gautam, and thank you for joining us. Clear views and a bit of caution on board as well, at least in the near term, as far as markets are concerned. So there's Gautam Shah, Goldilocks, with his thoughts. 30 points lower on the Nifty now. We're at about 25,010, and it's a bit sort of down and out. 1,400 stocks are higher and about 900 stocks are lower. So market breadth is still positive, although it's not. I mean, of course, nothing like what we had yesterday. Suzlon has climbed the leaderboard in terms of volumes. It's up 5%. I think that's the daily limit. And it's got very large volumes. And number 2 is Piramal Pharma with a 4% pop. There is Century Textiles, which is up about 3.5%. EPAC Durables was another one which moved up very sharply yesterday. And it continues its move higher. So 320. 4 days back, stock was at about 260. So that's a fast mover we've had here. And actually, that's about it. Volume-wise, not very much else is really showing up on the screen. Tata Motors is down 4. We highlighted that. Premier Energy, that was down about 4%. I think it's had a tremendous move since listing early last week. It's down another 2%. And of course, then you get to the oil stocks, Oil India and ONGC as well. So that sort of gives us a cue to talk more about oil prices and beneficiary and who gets hurt, etc. But let's summarize what's happening with oil itself, right? We've fallen under $70 a barrel, 15%, I think, in the last 10 days or so. That's very sharp. Hormuz has looked at what's driving this and what are the big views coming in from the global strategists. Hormuz, over to you.
You know, a lot can happen in a year, right? Around the same time last year, we were worried about oil prices hitting $100 a barrel, and now we are talking about oil prices correcting almost 15% in the last 10 trading sessions, and that is exactly what has transpired with Brent now down almost 30% from the highs of around $97 that it had hit on the September of 28th last year, and since then it's been in this corrective mode. And in this quarter itself, so far, it's now in almost down 20% in this July to September period so far, which is the worst quarterly drop since the third quarter of 2022. This shows the kind of correction that we've seen in the oil prices. Now, what is causing this? There have been a lot of demand concerns, particularly from US and China, which are the top 2 consumers, of course, and the top where the demand maximum originates from. And of course, there is this uncertainty over what the OPEC Plus is likely to do as well. Now, considering this fall in oil prices, OPEC Plus had already postponed their already planned output hikes, which were scheduled to begin from October by around 2 months. But then there is this uncertainty because this is not a decisive move that OPEC has taken, and there are plans to increase output by at least 2 million barrels a day by the end of next year, and that is also not giving any form of cushion to the oil prices. Now, what can support them on the downside? Well, there have been reports that came out yesterday that there was a rise in the US stockpiles. There is hurricane season going on in the US. There is one storm that is likely to make landfall today and more in the offing as well. And of course, there is any further output cut announcements that OPEC does end up making in the view of this falling prices. Now, what are strategists saying? JP Morgan believes that they expect Brent to average around $75 a barrel next year, but they expect the prices to dip to the lower 60s by the end of the year. And what Goldman Sachs also believes, for the next quarter, they expect the Brent to average around $77, but their range that they have between 70 to 85, that still remains skewed to the downside. And Citi also believes that Brent is on track to hit their target of low 70s by the end of 2024. And OPEC Plus is now caught in a very vicious circle of trying to sacrifice market share in order to defend price. So all in all, not good going for oil prices right now. There does not seem to be a floor in the offing.
All right, Hormuz, thank you very much for that. So those are some top global banks with their views there. Let's also listen into Hardeep Singh Puri, right, the energy oil minister, and he was speaking with my colleague Shireen Ban earlier at the India Energy Transition Summit. His thoughts on where oil prices were holding at that point. Listen in.
Ultimately, demand and supply. Yes. And I was very encouraged by your reference just now to OPEC having decided not to undertake production cuts. Hey, wait a minute. We had a production daily of 102 million barrels per day. Yes. They reduced their production by 5 million. I've seen statements by OPEC Plus to the effect that they will unwind those production cuts. Now, I'm on your side. If after the drop in oil prices, will they still, and I'm not tempting anybody, but I'd like to see, because they've told me at a bilateral level that they will, unwind. There are two things that I'm interested in. There is more oil in the market available. There's no shortage of availability. The price levels are maintained essentially on account of artificial holding back. Right. If the total amount of oil which is available in the world is allowed to be available, then I think we'd be in a slightly more comfortable situation. We have so far, Shireen, navigated the terrain reasonably well.
You know, the oil minister's comments actually seem very prophetic, because he made those comments on the 5th of September. He said oil prices are being held up artificially. Guess what? Since then, oil prices are down about $4. So that is, of course, Hardeep Singh Puri. We have Peter McGuire, CEO of Exim Australia. We also have Somit Pokarna, Vice President Research at Kodak Securities. So we'll get you sort of a global view on this and a local sense in terms of who benefits and who gets hurt. Gentlemen, good morning. Peter, if we can start with you. That was, of course, the India oil minister. Well, prices are down, and down how? So what's going on? Is this, should be, in terms of how markets are looking at this, is this an indication of weakening underlying demand? What's your sense, Peter?
Well, good morning, Prashad. I think a couple of things. Yes, it's very hard to argue against the oil minister, because quite simply, the way he describes it and the rhetoric he uses is so matter of fact. This market is in free fall in a lot of ways. It's taken everyone, I think, by surprise. If you're looking at what happened a year ago and where we are today, you've got a market down $30. There seems to be global weakness if you're looking at the likes of China. And the situation, I think, is plenty of supply. If OPEC were to move forward and increase their supply come end of year, and I know they've pushed it out, but if they were to do something like that, you would see, I would think, probably weaker prices than what we have at the moment. So it seems to be a race to the bottom, and it's a time to be short from a trading mentality, because, and it's incredibly volatile with the whipsawing that we see on nearly within a weekly basis.
So, Peter, how much lower do we go? Say on Brent, do we hit $60 per barrel? What about base metals? Do you have any targets in mind, any levels that one should keep an eye out on?
If you look at iron ore, we're at $90, but it's lower today than what it was over the last 5 years, Rima. So there's the first part of it. You're looking at copper still sitting at that 89 to 9,000 a metric ton. As far as oil, look, if you're sitting at 69, 62, if you asked me a year ago, you said, Pete, it's going to be down $30, I would have said, Rima, you're dreaming. But I tell you what, you can't say that, because the market is the market, and the war premium stripped out, geopolitical, even though you've got these ongoing sagas, there doesn't seem to be anything to push markets higher. So maybe you're looking at 65. I'll go out there and say Brent's got the capacity to hit 65, but we've got to have a closer look at it. once it is there and what the general themes are across the whole fabric of the oil market.
Peter, since you briefly mentioned about the ferrous space, where do you see Chinese steel prices headed? You know, they've seen a sharp decline, weak data, weak consumption. They're exporting more. So what's the level you're looking at on Chinese HRC prices? And even iron ore, the lowest we've seen in multiple years, at around $90 per ton. Where is that one headed?
Well, Nigel, I think, and it's good to see you, I think you've got to say 85's got to be the next target, you know, but when you're looking at it over a chart, it's just hard to argue against because the downside or the downdraft has been so dramatic. There's the first part, and it's certainly not doing anything, you know, wonderful for the Australian miners, so let's park that there. As far as Chinese demand and what you're going as far as those, you know, those finished goods, I think it's going to be softer prices. So that's where we sit as far as the base metals and ferrous. And I think one's got to be short to probably look at it from a trading perspective.
So, Peter, just one final question then, and then we'll, get chatting with Sumit also about the Indian markets and the implications. Apart from China, what else is driving the weaker demand? Are there any other geographies where, we're seeing slowing demand?
Well, Reema, you'd have to say across the fabric of Asia, a lot of that is a little bit softer, and certainly if you're looking into the United States. But the overall, I think, picture is that you've had, there was supply issues that OPEC took into consideration post-COVID, and now that's coming through to the other side of it where you've got plenty of production, you've got Libya back online, you've got a number of those other OPEC producers all wanting a piece of the apple. And you can't argue from the numbers. When you're thinking about the whole scheme of things, you're at 102 million plus barrels a day of consumption. So it's certainly not weak. But the story at the moment is softer prices and the potential to go lower yet.
Got that. Peter, we're going to come back to you. Let's welcome in Sumit Pokarna as well. He's with Kotak Security. Sumit, good morning. Good to have you here. So you heard the sort of global piece from Peter. So what are implications? Who are the big sort of outright beneficiaries and who gets hurt from a trading perspective for those who are watching?
Yeah. So every coin has two sides. Definitely falling crude oil prices is positive from India's point of view, and mainly because India's dependency on imported crude is very high. So to that extent, it is positive from current account deficit, fiscal deficit. It is also positive from companies like which are into retail fuel like OMCs, oil marketing companies, HPCL, BPCL, IOC. And then obviously paint companies and lubricant companies are also going to get benefited, but with a lag. So to that is on the positive side. But if I look on the other side of the coin, when the crude is falling drastically, that means some slowdown is visible in the global economy, and particularly China. The demand is not there, and we all know that China is the world's largest oil importer. So on the flip side, if any macro slowdown happens globally, and if that happens, then India will not remain immune to that extent. However, there is a demand-supply mismatch. The market is also anticipating that OPEC had guided for a production increase. So the supply, if it's because of the supply side, then I don't have any worry. But if it's because from the demand side, then I am really worried from maybe 6 months down the line what happens to the global economy.
Sumit, you started with this being a macro positive. What is the average sort of import price now? Because we are almost about 50% of what we import as a country comes from Russian oil, which I think is, in any case, a price much lower than where, Brent is at, or the Indian basket of crude, etc. is. So I just wanted to, do you have that number? There used to be that, yeah, go on.
Right, that number is not handy right now. Yeah, but definitely we are getting benefited. But need to be noted here that once the crude will fall down, the discounts which we were getting earlier might also fall down.
Yeah. Or maybe the discounts remain the same, so you're essentially benefiting, right? Because the price for Russian oil is also lower then, as compared to where... Yeah.
Right. So $60 comes anyway, it is big positive, irrespective of discounts. If the crude falls to 60, anyway, we are getting big time benefit from the fall in the general and markets. If you look at the other side of it, obviously oil explorers like ONGC and Oil India, they are going to get impacted majorly. And we have continuously been highlighting that because we are seeing the demand pressure globally. So we have seen that ONGC is, and we have been negative on both the stocks, ONGC and Oil India. So far, oil marketing companies are concerned. There I would like to highlight that obviously their marketing margins have improved drastically in this quarter till date.
Sumit, just a quick point. Do you think we'll see fuel price cuts by the government? Or because one argument is if you cut prices at the pump, states will increase VAT. So what's the point? Or you think the centre may actually cut excise duty?
Yeah, so that is a very difficult question to answer, to be very frank, but that all depends because we are heading towards 2 state elections also. So how does the government play? I would like to myself watch for the same.
All right.
So Sumit, just if prices stay where they are right now, what would be the marketing margins for oil marketing companies in Q2 versus Q1? And what's the earnings growth then that we're looking at?
Yeah. So oil marketing companies, if you look at diesel margins, which have increased by almost 46% in Q2 till date as compared to Q1 of last quarter, FY25. So that is a significant improvement, and currently average is coming to 5 rupees 10 paisa per litre for diesel. And coming to gasoline, that is petrol, the margins have been very, very attractive. They have increased by 88%. They are currently average out to 7 rupees 30 paisa as compared to 3.9 rupees in the previous quarter.
Okay, all right. Thanks a lot, Peter, as well as Sumit, for joining in and giving us your inputs on this important oil price move that we are seeing. Wishing you guys a good day ahead. Well, for the time being, though, we'll slip into a short break. On the other side, we'll connect with Pavitra Shankar, the MD of Brigade Enterprises. Stay with us. Well, Brigade Enterprises, the next management on the show. The stock has surged 47% in 2024 so far. The company recently raised 1,500 crore rupees by selling equity to institutional investors as part of the strategy to expand their business. To discuss this and more, how demand trends as well, we're joined by Pavitra Shankar, the MD of the company. Hi, Pavitra. Good morning. Always good to see you, Ben. Let's start with basically this fundraise, the QIP of 1,500 crores. How do you plan on utilizing it?
Hi, good morning. Yeah, we're very happy with the outcome of our QIP. We are looking to utilize the funds basically as growth capital. We are seeing that across the sector, all of the different domains, residential, office, retail, and hospitality that we're in are doing well. And we're looking to basically capitalize on that trend. Specifically, we're looking to use the growth capital for the residential sector.
Any part of this will be used to reduce your debt? Are you looking at debt reduction? Yeah.
On the residential sector, we've been running it debt-free for a few years now. We do employ debt in the company, mostly for CapEx to grow our lease rental portfolio. And once it's leased out, we used securitized, we securitize the lease rentals, and we basically have a very low cost of debt across the board. So predominantly it is for growth, but there will be some recycling as well.
Pavitra, hi, good morning. Prashant here. The underlying business, how is it panning out in Q2, Pavitra? I think in Q1 we did see a bit of a fall in terms of pre-sales and overall volumes. Have you seen recovery in Q2? And what is the growth guidance for the full year 25?
So in Q1, it wasn't just at Brigade, but multiple other of our peers as well did show slightly lower numbers. Those of us, especially with a lot of projects in Karnataka, face some slowness in approvals. Not just Karnataka, Tamil Nadu, Telangana, a lot of the South Indian states, we face some slowness due to elections and therefore some impact on approvals. But a lot of that has been getting resolved during Q2. In this kind of market, a lot of the sales numbers are driven by launches especially. So that's kind of why the Q1 numbers looked a little lower. But I would also say that it's reflective of what is able to come in for launch. So what all the indications that we have on ground is still that demand is very good. We're still getting a lot of walk-ins, responses to our digital marketing campaigns and so on. So we're quite confident that Q2 will be a lot better than Q1, and going forward as well for the rest of the year, for the financial year. It is to be supported by launches. We have about 12 million square feet coming up in launches for the next 4 quarters. And a lot of that should translate into sales for the numbers this year. So should be looking at a good, good FY25 as well.
You want to quantify that, Pavitra? What would good mean? The start has been a little bit softish for reasons you mentioned. But for the year, since you're seeing a recovery in Q2, you have so many launches as well, what should we end FY25 at?
So Brigade usually doesn't give guidance. We try to aim for a 15 to 20% year-over-year growth, and we're striving hard for that. As long as the launches are coming in, we're very confident of the sales.
So 12 million of launches over the next 4 quarters. How much of that will come in Q2?
So we are working on maybe another 1.5 to 2 million square feet to be launched in Q2.
Okay, all right. Let's focus a little bit on pricing then. You had that new Chennai project that you launched as well. So as a geography, how has Chennai been in comparison to, say, your core market or Bengaluru? And could you give us pricing trends in both these two markets as well?
Sure. So just in terms of overall market size, Bangalore absorbs about 50 million square feet of residential space annually. That number is still at around the 2013, 2014 level. So as a market, we're sort of just back up to where we were 10 years ago. Chennai is a little smaller than that. It's about 55 to 60% of the size of Bangalore. While in Bangalore, we enjoy a leadership position, in Chennai, that's one market that we have done a lot of groundwork. There has been substantial business development in Chennai for Brigade as well. And over the coming years, we'll be seeing a lot more residential projects coming up in Chennai. As a market, it was historically priced better than Bangalore and say higher than Bangalore. But in the last couple of years, we've seen dramatic price increase in Bangalore. So I would say it's sort of neck and neck right now. It really depends on the different sub-markets where we're launching projects. Our recent project that you were mentioning, Brigade Icon on Mount Road, that's done extremely well. We launched that in Q1. The RERA approvals came in early in Q2, and that has done extremely well. The average pricing there is about 27,000 rupees plus per square foot. So a 7 to 8 crore ticket size. So it's a very different project for Chennai and a very different project for Brigade as well. So we're excited for the prospect of residential segment in Chennai.
Just to push that point on pricing, I was talking to a banker. I mean, and he was saying that, and this is not about Bangalore, he was saying that across larger cities, right, price-led gain for land is a different issue, but for flats, that maybe we're kind of we past the peak. So that demand, I mean, actually, if people want to buy a home to live in, That's, of course, that demand, as you said, is very solid. But in a way, investment-led demand with an eye on potential gains that prices will go up, that's kind of maxed out. That was his opinion. I don't know if you have a view, Pavitra. Not just, I mean, I'm not talking about Brigade, but generally. Yeah.
Yeah. So in many of the key markets, top markets in the country, we have seen your double-digit price growth, quite eye-watering, actually. I would say most of that is probably behind us. It would not be right for us to keep expecting, substantial price increases where people are, in the past couple of years, it's been 20-30% increases. I don't think that is sustainable. And, we are still happy. I would say people in general should be happy with, a 5 to 6% growth as well. This is a real estate sector that we're talking about. While many people look at it as an investment, it is still predominantly in the residential side. It is predominantly where people expect to take possession, utilize that space, live there, etc. So in our own portfolio, we have a very high percentage of end users, and therefore we see that demand to be very stable. So I would say there is still some investor appetite for real estate because people should be looking, in a medium to long-term time frame if they're looking at the sector. There is some speculative demand, which I do hope remains minimal, because that would ensure that the cycle is a little more stable and, ends up being longer than, it can otherwise be.
Very quickly, Pavitra, on the hospitality portfolio, the occupancy went up, but the ARR was more or less flattish in the first quarter. You had guided for a 10% increase for the year. Do you think that's still doable? Is that still on the cards?
Yes, I think so. There's a lot of seasonality in hospitality. Q1 can generally be a little slower, but coming up with all of the festivals and conference season and so on, I think we should still be on track for that.
Okay, thank you very much, Pavitra, for joining in, and wish you all the very best. Now, moving on, the Ministry of New and Renewable Energy recently notified draft norms for an approved list of models and manufacturers, ALMM, for solar cells. It's proposed to be effective only April of 2026. These are draft norms. Now, Kotak Institutional Equities in their note says that this mandate is a potential positive for cell manufacturers. To discuss the opportunity, we have with us Mohammed Saif, partner of Power and Utilities Practice at EY, joining in. Thank you very much, Mohammed, for joining in. Share your initial thoughts on this draft notification. What is the total addressable market, and who would be the key players in India who would benefit, listed and unlisted?
So we have to first understand the ALMM background. This, before the intention of getting to the cell manufacturers, Government of India has already notified in 2019 the list for module manufacturers, which is, the integrated module, which has all the cells already intact. Now, this scheme went on through a process of updation. There was a pause last year, but as of now, if you see, we have almost more than 90 manufacturers who have already enlisted here. The major benefit that I see from this scheme is that most domestic manufacturers are going to have a very strong quality focus, given that we are going to be envisaged as one of the global manufacturing hub in solar very soon. So this scheme is a downstream upgrade of the earlier module manufacturer listing, where the cell manufacturers, which is the prime component of the module, are also being asked to, come into this empanelment and provide cells basis a very specific standard of quality. Now, the benefit that I'm seeing, as of now, if you look at the Indian cell market, it would be close to 7 gigawatt of manufacturing as compared to the module market, which would be somewhere around close to 70 gigawatt. When this ALMM would ensure that we would have a lot of manufacturers getting in, trying to compete in the solar cell manufacturing also, as has happened over the years in the module manufacturing. So if you ask me the addressable market, I mean, I can provide sort of an initial estimate, but somewhere till 2030, we are looking at this market of solar cell to go almost 7 to 8 times what it is today. would be somewhere around 49 to 50 gigawatt of manufacturing.
7 to 8 times by 2030 for cells.
Yes. What it is today, it is somewhere around 7 gigawatt.
7 gigawatt is cell capacity in India, and module is 70.
Module is around.
Yeah, and so far basically you had the module and then cells were imported and then put together.
Right.
You'd expect.
Right.
Yeah.
So what was happening till date was, while you had the module manufacturers which were enlisted, they had the choice of going overseas to source the cells. Now, with this step, from 2026, April 1st, what Government of India is saying is that the cell manufacturing and the sourcing by for all projects which are under the government scheme and even open access C&I consumers would be through domestic manufacturing of cells.
Okay. And so this completely, so globally, Mr. Saif, there is a big glut, right? And prices have come off very sharply. So we with these policies, we are completely insulated. We will remain insulated?
So see, we have to also understand the complete supply chain when we talk about solar cells, solar modules. But before that, you also have ingots, wafers, etc. We still would be depending a lot when you talk about the raw material for solar cells. That is a reality. But I believe in a longer term, when the domestic manufacturing would start maturing, I'm sure the supply chain overseas would also start getting, controlled in a better way. As of now, you're right. The supply chain would primarily be dependent upon the global cues.
So you'd make the cell here, and what goes? So there is, but we're dependent on import of wafers in a very big way, right?
Correct.
To what degree, and if prices there come off, then what does it do to, the end product?
So you have to look at it that at any point of time, whenever someone is trying to develop a solar project, the cost of the module depends upon the price trends in the global market for the raw material. So you can't predict that, but yes, it is cyclical. Depends upon a lot of factors, including the geopolitical things that are happening. So you can't predict that in a nutshell, but yes, it is coming down. If you look at the overall trend for the last 6-7 years, that is what best. But yes, controlled by foreign players as of now, if you talk about the raw material.
Okay, and if viewers who are watching and potential investors, what part of the value chain should they focus on to invest into?
Apart from solar module and cells, or you're talking about?
Those included. What should they look at?
Right. So
actually, utilities who are putting all of this together and generating power, should they look at component makers, module cells? Which part?
So if you see, as I mentioned, that while the module manufacturing is quite getting matured, the cell manufacturing is something which actually has a very strong market when you talk about domestic manufacturing. Obviously, this would require a lot of supply chain tie-ups globally, but that again, and with a focus on this ALMM in 2026, I think the next 2 years are going to see a lot of investments in solar cell.
All right, fair enough. We'll leave it there. Mr. Saif, a quick primer of a discussion. I think we kind of scratched the surface, but hopefully it was useful for viewers. Thank you for joining us and taking us through, some of the details on the solar cell. Largely, solar cells is where the big capacity expansion is going to happen from current 7 gigawatts to 7 to 8 times of that by 2030, according to Mr. Saif there. We'll take a quick commercial break here. Mitesh is going to be with us on specific trading ideas and a look at the market as well. I think we came back into the green for a brief while, and we're down again. Stay with us. Okay, welcome back. Market's down about 20. I just want to take a quick look at Paytm, which has moved to the high point of the day. It's up about 3% higher, yeah. And that's sort of started flat, but has since picked up pace. Mitesh is back with us with what he wants you to do. Mitesh, over to you. What's in your radar?
Prashant, on the indices, not much because they are very quiet and subdued in a range. But some stocks are showing good continuation and breakouts into new highs, and one of them is Dow. I talked about FMCG as a pack a few days back as well. I think they continue to outperform, and Dow now gives you a trading opportunity with a stop below levels of 660 for targets of 690.95. And the other one which I like is Berger Paints, again showing fresh swing high. So buy here with a stop at 605 for targets of 639.
Thank you very much for that. In a story which could have implications for PSU banks, now the MTNL account is likely to slip into NPA category for most lenders in the current quarter because MTNL has defaulted in its repayments. Ritu joins in for more on that. Ritu.
Well, here you have the case of MTNL, a government-owned entity which has defaulted on its loan repayments and is now asking state-owned lenders to take a significant haircut, a proposal that has not been well received by banks. Now, after missing loan repayments for the past few months, we understand MTNL is expected to slip into the NPA category for most of these lenders in the current quarter. The likes of Union Bank of India and Bank of India have already classified the account as an NPA, and others like State Bank of India, UCO Bank, Punjab National Bank and others are likely to follow in the coming weeks. Now, banks have made it clear to MTNL, while they are open to restructuring, including a possible debt-to-equity conversion, but they have firmly rejected any request for a haircut. In fact, MTNL had earlier proposed a repayment plan offering to pay only about 40% of the dues, which we understand banks have turned down. Now, our sources also indicate that lenders have made representations to the Ministry of Finance, stressing that a haircut from a government-owned entity will send a negative message and set a troubling precedent for the industry. Now, keep in mind, collectively, these lenders have an exposure of nearly 7,900 crores to MTNL, and this is where they will have to make higher provisions in the current quarter, while another 27,700 odd crores of the company's debt is in bonds that are backed by a sovereign guarantee, so there's no issue there. Now, the company had disclosed earlier this month that it had defaulted on 519 crores of repayments to Union Bank, Bank of India, SBI, PNB, Punjab and Sind Bank, as well as UCO Bank. And some of these lenders we spoke to said that given MTNL's weak financial position, it will probably require an intervention on external help in the form of capital support from the Government of India for the company to meet its repayment obligations. A meeting of the lenders is expected soon to deliberate on this debt recast plan.
Okay, thank you very much for that. We're going to slip into a very short break with the news that it's absolutely flat on the Nifty and the sensex. The Nifty, though, holding on to the 25,000 mark. Autos continue to remain under pressure. We'll get into a break. On the other side, an exclusive conversation with the management of L&T. Stay tuned.
Welcome to It's the Economy. Larsen & Toubro recently announced that it is carving out its renewable EPC business out of its overall power T&D vertical and its utilities vertical. What are the reasons for this carve out? Is there a separate listing being planned, considering that power companies and their utilities are doing so well? What is the state of the Indian and, more importantly, even the global solar power industry, where we believe there is overcapacity? For all these questions, I'm joined by Mr. T. Madhav Das, the whole-time director and senior executive vice president in charge of utilities at L&T. Mr. Madhav Das, thank you very much indeed for sparing time for us. First, if you can take us through this carving out of the renewable EPC business as a separate vertical, what does it mean and what is the reason?
Thank you very much, Lata, for having me on the show. And it's a privilege to speak on this. And as we have been incubating this solar business under T&D for pretty long, we have been executing some huge projects. We have been building up our credentials. And in the last few years, we have delivered some marquee projects across international as well as domestic scenario. So this helped us to scale up our operations, build up an ecosystem which can constantly on a sustainable basis deliver projects of large scale. This, coupled with the fact that energy transition is one of the key factors which can bring about huge impact on climate change, and with the advancement of huge technology both in solar and storage batteries, I think the renewable generation has become a reality. It is only going to grow leaps and bounds as we go forward. And hence, since we had incubated this business and we decided to separate it out from the transmission and distribution and give an identity of its own so that there is clear leadership oversight, there is clear customer proximity. At the same time, there is good amount of skill building that is required to be done, and it brings in a large amount of focus. And the clientele base also is slightly different when compared to the T&D, and hence we decided that this will bring much more focus in the way we deliver these large-scale projects.
No, I take your point, sir. In fact, I was going through some Bloomberg data, and apparently solar and wind together have accounted for 91% of the additional capacity in 2023. And of that, solar itself has accounted for over 70% of the additional capacity. I can imagine that you are getting a lot of business there. But more from the point of view of your investors here, will you look at listing it separately, since power companies are doing so well?
No, I think we will still be a part of the infrastructure segment of Larsen & Toubro, and I think there are no immediate plans for listing. However, if you see the way Larsen & Toubro has been going about its green portfolio, we have brought more attention onto the renewable EPC. We have created a green energy segment so that there's clear focus on hydrogen as well as on electrolyzer manufacturing. At the same time, our infrastructure of heavy civil has been doing pump storage. So we have been giving a very great emphasis on green energy, because this is the real way of energy transition which can bring about reality into the world. And hence, within the group of L&T in the infrastructure, there is a clear focus that we should concentrate on green energy, but there's no immediate plans for listing.
Okay. Well, there was another interpretation I heard from the market that probably the renewable business is largely focused abroad and probably in the Middle East, and it has margins which are lower than the margins of the rest of L&T. Is that a reason to carve it out?
No, let me put it this way. The renewables business has grown to a size which requires very heavy oversight. Okay. At the same time, today we have 15 gigawatt of projects under various stages of execution. And hence, it is absolutely necessary that the clients understand that L&T is giving very good focus on this growing business area. That was one part of it. At the same time, we have a large portfolio of this being done in international market where the clients are slightly different and they require a huge focus. So we brought about. On the margins, I don't see any difference. I think we have been doing well, and it is among the L&T portfolio, it is with a reasonable amount of margins. I don't see anything which pulls it down.
Okay, excellent. So that clears some misconceptions then. What about getting into solar module manufacturing itself? The government is giving a lot of incentives there, you know, that AMLL rule, import duty, tariffs. Will that be something that you will venture into?
No, I think that is a decision which we have taken. We will not be getting into solar module manufacturing at this stage. I think our focus is more on green hydrogen electrolyzer manufacturing. And going forward, we are keeping the options open for battery manufacturing, especially for storage, as this will dovetail into the renewable capacity addition, which is along with solar. I think this is something which will be required. So we are keeping our options open on battery there. Okay. This is the way we look at it.
Okay. So that at least helps you escape the ups and downs in the solar module industry. But any thoughts on the module industry itself? Not just modules, the entire chain, we believe, is now going through a bit of an overcapacity globally. Does that affect you all in any way in terms of orders, in terms of receivables?
The way it is structured, most of these projects, I think the clients also step in when we do these sort of projects, and hence I think this, from a developer point of view, this is a boom time for them because they find the module cost at the lowest. And hence, large capacities of jobs are coming up in the Middle East, which we are targeting. And with this overcapacity, the supply also, there is no pressure. So hence, the projects are getting executed much faster. So I think there is a upside on this condition. Okay. So people are making use of it, actually.
Okay. Now, can you tell us how it is impacting order book? While, of course, execution is very good, does it taper off in terms of order book? What did you all start with in terms of order book in power EPC, and will you likely whittle it down at all?
No, let me put it this way. The T&D segment remains to be the backbone of one of our verticals within L&T, because this was where we incubated the solar business.
Yes.
And the power transmission backlog itself is close to around about, within the infrastructure segment, close to 45 to 50,000 crores of T&D pure, which is spread over India and domestic, leaving the renewables aside.
Okay.
And in renewables, as I told today, we have a clear backlog of 15 gigawatt peak of jobs under construction, which is a very large portfolio in terms of value. And the way we see with the Middle East giving very heavy emphasis on solar projects across the whole Middle East, Government of India giving huge emphasis on 50 to 60 gigawatt pipelines of project every year, or there is sustainable way we see a large number of projects going to come up in the next decade. And hence we see a continuous business available for renewables.
Can you put some numbers? What was the order book like in FY23? What is it likely to grow to?
Okay, I think on that's why I said I am going by gigawatt. I didn't want to put a number.
Fair enough.
Way back in, let me put it this way, when we started this business in 20, we had around about 2 to 3 gigawatt of business going on. And today we have scaled it up to a backlog of around about 15 gigawatt after completing 4 to 5 large projects. And hence, this will be the range of order book as we go forward, because there will be continuous commissioning of projects at the same time an inflow of projects coming in.
Okay. Could you just give numbers for FY24 and FY25? How much is the order book?
So at FY24, it would be, the way I see, we were close to around about 7 to 8 gigawatt, and FY25, we will close at around about 15 gigawatt.
Oh, okay. So that's a sizable, it's a doubling
Yes.
of your order book. Okay. Can you throw some light on the, capacity, demand, supply dynamics in India itself? We just heard murmurs that there is already, solar capacity more than DISCOMs are willing to, evacuate. Is there any fear like that?
See, the way central agencies are going about putting the transmission infrastructure, there is no hesitancy at all. There is a whole plethora of projects which has come out, especially in the last 2 to 3 months. Further, there are at least 30 to 40,000 crores worth transmission line projects already lined up to do the evacuation. And hence, I do not see any hesitancy in terms of the transmission infrastructure not coming up. So that first takes care of the evacuation of projects, which is 100% in pipeline, with some of the HVDC links also being looked upon. So we do see a complete clear pipeline available for the transmission. And then comes the distribution side of it. Yes, on the distribution side, there has to be a little more, modernization to be done to ensure that this reaches the last minute point. And I think green energy is going to be a way of life. So hence, I think this could be a transition phase where people will have to start looking at, most of the industries will start looking at using green energy, and hence the boom will come back. Boom will be there, is what we feel.
Okay. Actually, you are best placed to tell us about, all aspects of the power sector. So if you can give us an idea, by when do you think storage capacity will be sizable in India? By when do you think green hydrogen will become a reality? Are we looking at 3 years out? Are we looking at 5 years out? Just draw the power scene for us, say, 3 years from now.
So the way the capacity addition of storage of renewables as well as coal-based nuclear is going on, I think that has got a very clear trajectory as we go forward. We don't see any issue on it. The most key aspect is when we have the variable generation from renewables. The most important thing that happens is to have a clear visibility on the pump storage as well as on the battery storage, because this is something which will ensure that the smoothing of power takes place. And we have been seeing a lot of activities happening on this front. Suddenly we see a lot of emphasis being given on pump storage. L&T itself is doing 2 pump storage in the market today, in India today. And there is a lot more clear focus by the government also in projects that are coming up. We ourselves have nearly 1,000 megawatt hour of projects, nearly about 750 megawatt hours of projects lined up in India for storage battery coming up. So it is picking up. So the way we see within 2 to 3 years, this coupled with the fact that the battery prices across the globe has come down, the way module prices has come down, it is coming to a level which will make it very viable. There will be a lot more push on to round the clock sort of energy requirement, which will require batteries also to come up in a big way. So I think this will pick up. This is a trend in India. Abroad, we suddenly see standalone battery packages coming up from the clients who wants to put 2 to 3 gigawatt hour of battery at a single place to ensure that these solars are, it has got a smoothing on the solar thing and the night time. So this is 100% sure that it will pick up. This along with pump storage would be the long-term way the government is looking at it. And this is happening here in India also today.
Okay. Well, at the moment, the UAE Crown Prince is in India for talks, and the CEPA is being reviewed. They've also signed up even for nuclear projects in India. Is there any headline from Larsen in these conversations? Are you all picking up more projects?
Abu Dhabi and UAE has been a pretty large ground for T&D for L&T. We have been doing multiple jobs across Dubai for Deva, Abu Dhabi. We are now just starting a 400 kV large substation for them. We are doing the solar park of 2 gigawatt in Deva 6 going on. So for us, UAE has been a very important marketplace for Larsen & Toubro in T&D and in renewables. And the way they have a very progressive outlook. We are very sure that the next 5 to 8 years, there are going to be huge amount of business for us there.
Okay. For one moment, just don't wear your utilities hat, but wear the overall L&T board member hat and tell us, would you all want to increase your either order book guidance or your margin guidance for the full year, going by the increased interest?
I think at this stage, we will be a little cautious in changing any numbers, because I think the first 6 months decides the trajectory on how we will go. And I think it's a matter of few more months that we will be coming out with our market analysis, and we will be giving that to the market.
Oh, yeah. I guess in 6 weeks, you will have your second quarter numbers. We will wait for that. Thank you very much, Mr. Madhav Das, for giving us an idea of L&T's renewable energy plans and the reasons for the carve-out. Thank you very much for sparing time with us.
It was a pleasure talking to CNBC and to you, Lata. Thank you very much.
Okay, so that's the word coming in from Larsen & Toubro. The reasons for the special carve-out is not listing, which is what the market was interested in, nor is it lower margins, as some of the pessimists were putting it. It's simply because it has become a very big business and they want to give it special attention. That's the word from Larsen & Toubro. Thank you very much for watching this edition of Bazaar.